Zimmer Biomet, ticker ZBH on the NYSE. Founded in 1927 in Warsaw, Indiana by Justin Zimmer as an orthopedic appliance business, the company has spent nearly a century building the world's most comprehensive hip and knee replacement franchise.
Today, Zimmer Biomet supports approximately 2 million orthopedic procedures annually across 100-plus countries, with over 10,000 product SKUs and 1,800 ROSA robotic surgery platform installations in hospitals globally.
The company pioneered the modern knee arthroplasty implant in 1972. Bristol-Myers Squibb acquired Zimmer in 1976 and spun it off as an independent public company in 2001 to refocus on pure orthopedics. The 2015 Biomet acquisition for $13.4 billion created the largest pure-play orthopedics company in the world.
Ivan Tornos became president and CEO in 2023, arriving with an industrial engineering degree from Valladolid, an MBA, and 3 decades in medical device sales and operations, most recently as COO of Zimmer Biomet itself.
The revenue mix breaks across 4 segments: knees at 40%, hips at 25%, SET, spine, extremities, and trauma at 26%, and other at 9%. Total revenue is $7.7 billion.
Gross margin runs at 70.2%, the natural outcome of a business that sells precision-engineered surgical implants with decades of clinical validation. Adjusted EBITDA margin is 24.8% and improving. Adjusted EPS grew 7% year over year.
The surgeon relationship moat is the foundation. Orthopedic surgeons train on specific implant systems during residency and fellowship, then practice with that system for their entire career. A Zimmer-trained surgeon generates decades of predictable, high-margin implant orders without requiring a new sales effort.
The ROSA robotic knee and hip system adds a second moat layer. Hospitals that install ROSA optimize their workflows around Zimmer Biomet implants, creating institutional switching costs at the hospital level that complement the individual surgeon relationships.
On the competitive radar, Zimmer scores 90 on demographic tailwind and 88 on surgeon loyalty. Stryker leads on robotic platform strength with its Mako system. Both Stryker and Medtronic carry stronger balance sheets. Zimmer's 3.2 times leverage reflects the 2015 Biomet acquisition debt that is still running off.
The demographic tailwind is the most reliable long-term argument. 70 million U.S. baby boomers are entering the 65 to 80 age cohort, the decade when 80% of all knee and hip replacements are performed. That wave peaks around 2030.
Warsaw, Indiana, the most concentrated orthopedic device cluster in the world. 90% of U.S. orthopedic implant companies are headquartered within 50 miles. The engineering talent, supplier relationships, and regulatory expertise concentrated in this region took generations to build.
Tornos is executing the operational turnaround that preceded his CEO appointment. Margin expansion through mix improvement, supply chain efficiency, and ROSA robotic surgery share gains. His COO background means he owns every operational assumption in the plan.
Zimmer Biomet has been replacing hips and knees for 97 years. And with 70 million baby boomers entering the prime joint replacement decade, the procedure volume tailwind is the most reliable demographic story in medical devices.
The tariff headwind on imported metal components is the friction. If Ivan Tornos can pass those costs through while expanding ROSA robotic surgery share, the leverage unwinds and the stock re-rates. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive. Welcome to Charged Alpha. I am Lana, and with me is Hudson. Zimmer Biomet reported Q1 2026 earnings before the market opened today. Revenue beat estimates. Earnings missed by 34%. The stock is down 7% and touching its 52-week low. We are breaking down why.
The headline is a 34% EPS miss, $1.22 versus the $1.86 consensus estimate. On a company carrying $7 billion in net debt, a miss of that magnitude resets every assumption about the EPS recovery timeline that analysts had built into the model. Quick anchor. Zimmer Biomet traces its roots to 1927, a Warsaw, Indiana startup that became the world's largest pure-play orthopedic franchise through nearly a century of clinical innovation and the $13.4 billion Biomet acquisition in 2015. Today's story is what happened in Q1 2026.
The context entering the quarter. Procedure volumes were recovering, ROSA robotic surgery installations were accelerating, and the Street expected Zimmer to deliver adjusted earnings of $1.86 on $2.071 billion in revenue. Revenue held. Earnings did not. What changed this quarter? Revenue came in at $2.087 billion, up 9.3% year-over-year from $1.909 billion in Q1 2025. The top line beat estimates by 0.8%. Procedure demand is real, growing, and broad-based across all four segments.
Knees, hips, spine, extremities. Every segment contributed to that 9+% revenue growth. The demographic tailwind of 70 million baby boomers entering their peak joint replacement decade is not an abstraction. It is showing up in Zimmer's quarterly revenue with consistent, visible acceleration.
So why the miss? Gross margin actually improved 72.4% in Q1 2026 versus 71.2% a year ago. Operating income jumped 27% year-over-year to $373 million. The miss did not come from the core business, it came from below the operating line.
Tariff-related cost pressures on imported metal components and subassemblies were the primary driver. Zimmer Biomet imports a meaningful portion of its implant materials and manufacturing inputs from China and Southeast Asia. Q1 2026 saw those costs accelerate beyond what the non-GAAP adjustment framework captured, compressing earnings below the consensus estimate.
FX headwinds compounded the damage. Approximately 50% of Zimmer's revenue is generated outside the United States, and a strengthening dollar reduced the reported value of those international earnings without corresponding cost relief. The combination of tariff pressure and FX created a below-the-line compression that the top-line strength could not offset.
On ROSA, Zimmer Biomet maintained its robotic surgery installation targets for FY 2026. The platform now has over 1,800 installations globally, and Q1 continued the positive trajectory of ROSA preferenced implant volume. The robotic expansion is on track. The cost pressures are the dislocation.
Management maintained FY 2026 revenue guidance while revising adjusted EPS guidance modestly lower to reflect approximately $100 to $150 million of potential tariff-related cost headwinds in the back half. That is a mid-year flag, not a full-year collapse.
The Q1 2026 headline numbers. Revenue, $2.087 billion, 9.3% above Q1 2025 and 0.8% above the estimate. Gross profit, $1.510 billion. Gross margin, 72.4%, best gross margin quarter in the past 8 periods.
Earnings per share, $1.22 versus the $1.86 consensus, a miss of 64 cents, 34.4% below estimates. The stock fell 7% on the print, briefly touching $84, within cents of the 52-week low of $84.59.
Operating income for the quarter, $373 million, a 17.9% operating margin, up from 15.3% a year ago. Every metric on the top half of the income statement improved. Revenue grew 9%, gross margins expanded, operating leverage clicked in, and yet the EPS missed by a third.
Below the operating line, interest expense on $7.5 billion in total debt ran approximately $125 million for the quarter. Annualized, Zimmer spends roughly $500 million annually on debt service alone. That cost does not shrink unless the debt does.
The gap between operating income improvement and EPS delivery is a leverage story. Zimmer's debt load magnifies every cost pressure that appears below the EBIT line. Tariff-related adjustments, FX losses, and higher-than-expected interest costs all ran through a structure where $500 million in annual interest expense leaves limited tolerance for surprises.
Year over year, operating income grew 27.7%. Net income grew 30.8%. GAAP EPS of $1.22 was 32% higher than the 92 cents a year ago. The business is objectively better than a year ago. The miss was entirely against an estimate that modeled non-GAAP adjustments which did not materialize at the expected scale.
Management's forward EPS projection for FY 2026, $7.10 to $7.40 on an adjusted basis, revised from the prior $7.80 to $8.20 range. FY 2027 consensus sits near $8.10 adjusted, implying 12% EPS CAGR from the revised FY 2026 midpoint.
The balance sheet, cash and equivalents $424 million. Short-term debt $1,176 million. Long-term debt $6,295 million. Total debt $7,471 million. Net debt $7,047 million.
That $7 billion in net debt is the legacy of the 2015 Biomet acquisition, $13.4 billion that created the world's largest pure-play orthopedic franchise. The purchase was strategically correct. It built the most comprehensive knee and hip portfolio in the market. The cost was a decade of financial leverage the company is still running off.
The near-term maturity structure matters. Short-term debt of $1,176 million comes due within 12 months. At current FCF generation of approximately $900 million annually, Zimmer has the capacity to refinance or retire that debt without accessing equity markets. The liquidity runway is intact, but execution must be clean.
Net debt to EBITDA, 4.2 times, the highest ratio in the large-cap medical device peer group. Stryker runs at 1.8 times, Medtronic at 2.1, Boston Scientific at 2.3. Zimmer's leverage is structural, improving, but still the primary reason the equity trades at a discount to peers on every valuation metric.
The current ratio is 2.94. Current assets cover current liabilities by nearly 3 times. Liquidity is not the concern. The concern is the absolute level of debt and what happens to interest coverage if EBITDA disappoints. At current levels, interest coverage runs at approximately 2.6 times. Acceptable, not comfortable.
The income waterfall for Q1 2026. Revenue $2,087 million. Cost of revenue $577 million. Gross profit $1,510 million at 72.4% gross margin. R&D $103 million. SG&A, the massive direct sales force that maintains surgeon relationships globally, $1,034 million.
That SG&A line at 49% of revenue is the structural cost of the surgeon loyalty moat. Zimmer Biomet employs one of the largest direct medical device sales forces in the world because the relationship between a sales representative and a surgeon is the primary competitive defense. You cannot cut that line without losing the accounts.
R&D of $103 million, 5% of revenue, funds the next generation of ROSA robotic surgery capabilities and implant design. This is below Stryker's R&D investment rate, which runs closer to 7%. The gap in R&D intensity is one reason the Mako platform maintains a technology lead.
After interest expense and taxes, net income $238 million. 11.4% net margin for the quarter, stronger than the trailing 12-month average, reflecting seasonal Q1 procedure volume. Free cash flow on a trailing 12-month basis, approximately $900 million, the primary tool for debt reduction.
At $900 million in annual FCF, assuming modest working capital and growth investment, Zimmer can reduce net debt by $700 to $800 million per year. From $7 billion today to $3 billion takes approximately 5 years at this pace. The deleveraging thesis is real. The question is patience and execution.
Peer comparison, Zimmer Biomet at 14.1 times EV to EBITDA. The cheapest orthopedic or large-cap medical device name in this peer group by enterprise value multiple. Stryker at 24 times, Boston Scientific at 20 times. Even Medtronic, the challenged, diversified giant, trades at the same multiple as Zimmer, despite materially weaker revenue growth.
In the orthopedic implant market, Zimmer Biomet's primary rivals are Stryker and Smith Nephew. Stryker at $124 billion market cap versus Zimmer's $16.5 billion. Stryker trades at a 7 times EV to EBITDA premium to Zimmer, justified by the Mako robotic platform lead, a cleaner balance sheet, and 12% revenue growth. The valuation gap is both the risk and the opportunity.
Smith Nephew at 10 times EV to EBITDA, cheaper than Zimmer, is the cautionary tale for highly levered orthopedic names. SNN has struggled with operational execution and competitive share losses for years. Zimmer's 9% revenue growth and 72% gross margins confirm it is not Smith & Nephew, but 4.2 times leverage prices any operational stumble as a credit risk event.
Medtronic comparison, MDT at 14.2 times EV to EBITDA, identical to ZBH, but Medtronic carries 2.1 times net leverage versus ZBH's 4.2. Medtronic pays a 3.4% dividend while ZBH pays nothing. The market gives ZBH no credit for superior revenue growth at 9.3% versus MDT's 4.5%. That is the leverage discount in action.
Options activity heading into Q1 earnings. Put-call ratio of 0.85, modestly bearish positioning, consistent with a stock that had underperformed since the start of 2026 as tariff concerns mounted. Implied volatility rank at 72 elevated, reflecting genuine uncertainty about the EPS outcome. The implied move, 5.2%.
The actual post-earnings move, negative 7%, nearly 2 full percentage points beyond the implied 5.2. Put buyers were right directionally. Delta hedging demand from large put open interest at the $85 strike likely amplified the initial sell-off, pushing the stock briefly toward the 52-week low.
What the options market is pricing for Q2, a higher implied move and skew heavily weighted toward put protection. The EPS uncertainty premium has been repriced upward. If ZBH demonstrates tariff cost management and EPS stabilization in Q2, the implied volatility will crush, providing a tailwind for long positions entering ahead of the print.
Insider activity. No open market purchases in the past 12 months, including by CEO Ivan Tornos, who has been in the role since 2023 and has not bought shares at current prices. The absence of insider buying at or near 52-week lows is a notable absence, not a neutral data point.
Analyst Consensus, 17 buy, 21 hold, 3 sell. A hold consensus at near 52-week lows. Average price target, $102.88. High target, $120. Low target, $89. Current price, $85.40. The upside to consensus target, 20.5%.
Post-earnings analyst actions. Morgan Stanley moved from overweight to equal weight, citing the EPS mismagnitude and downward revision to adjusted EPS guidance as evidence that the tariff headwinds are more persistent than previously modeled. UBS and Barclays maintained hold in equal weight. Piper Sandler held its overweight, citing the long-term demographic demand floor.
What does a hold at near 52-week lows mean? It means the street believes the stock could go either way from here. The 20+% upside to the average target represents the bull scenario. Tariff costs pass through, EPS recovers, debt continues to decline. The 3 sell ratings represent the bear scenario. A second EPS miss in Q2 reprices the equity as a credit risk story.
The forward estimates after the revision. FY 2026 adjusted EPS, approximately $7.10 to $7.40, down from $7.80 to $8.20 pre-earnings. Revenue guidance maintained in the $8.5 to $8.8 billion range. FY 2027 adjusted EPS consensus, near $8.10, implying 12% year-over-year growth from the revised FY 2026 midpoint.
The implied path forward, Q2 2026, shows partial EPS recovery as tariff cost pass-through pricing takes effect. Q3 and Q4 demonstrate the original operating leverage thesis. Gross margin holding above 70%, operating income continuing to compound. If that plays out, the equity is a straightforward re-rating story from current levels.
Capital allocation for FY 2026, no dividend, no buybacks, debt reduction as the sole capital return mechanism. With $1,176 million in near-term maturities and FCF generation of $900 million, the company should be net neutral to slight positive on cash after debt service. The financial architecture is austere by design.
The FY 2027 thesis rests on one calculation. At current FCF generation, Zimmer reduces net debt by $700 to $800 million annually. Net debt to EBITDA moves from 4.2 times today toward 3 times by FY27. At 3 times leverage, the equity re-rating potential is significant. The credit risk premium collapses and the multiple expands.
The bull case requires three things. 1. Tariff cost pass-through succeeds, and H2 2026 EPS demonstrates recovery from the Q1 miss. 2. ROSA robotic surgery accelerates installations and preferentially routes higher-margin knee implant volume. 3. FCF generation holds at $900 million plus, and debt reduction stays on schedule.
Bull Pillar 1, demographics plus procedure volume. 70 million baby boomers in the 65 to 80 age bracket are not going to stop needing knee and hip replacements because tariffs went up. Orthopedic procedure demand is medically driven. It does not respond to macro sentiment or import costs. That floor under revenue gives ZBH unusual earnings recovery visibility once cost pressures normalize.
Bull Pillar 2, ROSA-driven implant mix improvement. ROSA installations preferentially route surgeons toward Zimmer's premium knee and hip implant lines, the highest margin SKUs in the portfolio. As the ROSA installed base crosses 2,000 hospitals, the mix shift toward premium implants structurally expands gross margins without requiring new sales effort.
Bull Pillar 3, the leverage unwind re-rates the equity. At 4.2 times net leverage, every dollar of debt retired reduces the required equity risk premium. When net debt to EBITDA reaches 3 times, likely by FY27, Zimmer's EV to EBITDA multiple should expand from 14 toward 18 to 20. That is a 25 to 40% multiple expansion on top of EPS growth.
The bear case. First, leverage vulnerability. $7 billion in net debt at 4.2 times EBITDA is the highest in the peer group. A second EPS miss in Q2 2026, even a modest one, reprices the equity as a credit story, not a fundamental one. The question becomes not the fair value of the business, but the distressed equity value under a refinancing scenario.
Second bear pillar, Stryker's competitive moat. Stryker's Mako robotic platform has a multi-year installation lead over ROSA. Hospital capital budgets do not support switching robotic platforms once Mako is installed. If Stryker defends its robotic advantage through FY 2026, ROSA's installation acceleration slows, and the primary bull thesis loses its strongest catalyst.
Third bear pillar, tariff escalation beyond the estimate. Management flagged $100 to $150 million in H2 2026 tariff headwinds. If the policy environment worsens, additional tariff rounds, supply chain disruptions, or Chinese retaliatory measures targeting U.S. medical device imports, the $100 to $150 million estimate becomes the floor, not the ceiling.
Our read hold with a conditional buy trigger. The business fundamentals, 9.3% revenue growth, 72% gross margins, 28% operating income growth, are genuinely strong. The EPS miss was a cost structure shock driven by identifiable headwinds, not a demand implosion. The stock at near 52-week lows prices in more than the current reality warrants.
The conditional buy trigger, if Q2 2026 demonstrates even partial EPS recovery, adjusted EPS above 170 against an estimate of 175, the tariff narrative begins to normalize and the stock has a clear path to $95 to $100. If Q2 misses again, the bear scenario gains structural support and the thesis is broken.
Zimmer Biomet CEO Ivan Tornos said on the Q1 2026 earnings call, "The demand environment for orthopedic procedures is robust, ROSA continues to gain share, and our pricing power is intact. We are managing through cost headwinds with discipline." That is the operational thesis in one sentence. Now the company has to execute on it.
If you found today's analysis valuable, subscribe to Charged Alpha wherever you listen to podcasts. This was Zimmer Biomet Holdings, ticker ZBH, Q1 2026. I am Hudson. She is Lana. We will see you on the next one.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall